It is my professional opinion that now is the time to panic.
Given the increasing volatility we've seen in the markets in 2018, it may be becoming more challenging to resist the temptation to panic. However, like we usually do, we're going to take a step back from the emotion for a moment and try to evaluate the stock market through an objective lens. With that, we'll take a look at what I believe are the 3 biggest risks for the stock market right now. And at the end of this video, I'll explain how I'm personally navigating some of these risks within the context of my portfolio strategy. I'll then leave you with some practical advice that you can use to help navigate these periods of stock market volatility. And if you're new here, feel free to subscribe and join our investor community if you like content like this. With that all being said, let's jump into it. So first, I want to provide just a little bit of historical context for the markets in general. This is a stock price chart of the S&P 500, generally representative of the US stock market over the last roughly 25 years. During this time, we've seen 2 significant bear markets, the first starting in 2000 to 2002, and the other one being in 2008. However, since 2008, over the last nearly 10 years, we've been in one of the strongest and longest bull markets in recent stock market history. This means that many investors today have never experienced a bear market firsthand. And many times it's only during those bear markets that we find out the true risk that was inherent within the stock market. With that, we'll introduce what I believe right now is the largest risk in the stock market, which is the elevated overall levels of stock valuation. Now, what effectively this means is that compared to historical norms, the stock market prices are much higher compared to fundamental business metrics like earnings. What this means is that compared to historical averages, stock prices are higher today relative to fundamental business metrics like company earnings. Now, over the long term, stock prices typically follow the growth of a company's earnings. However, in the short term, prices can rise significantly above the rate of growth in earnings or significantly below, leading to periods of overvaluation or undervaluation respectively. Behind me is a graph of the Shiller PE ratio, which is effectively a metric that compares the price of the general stock market to its average inflation-adjusted earnings over the last 10 years. By this metric, stocks are now as overvalued relative to earnings as they were during the peak of the 1929 stock market bubble. The only other period in modern financial history where valuations were higher were during the 2000 dot-com bubble. What high valuations like this means is that if simply the market sentiment changes, we could see dramatic reversals in stock prices, even if company earnings remain strong. And if we were to see any economic troubles that would actually decrease earnings, we might even see more of a dramatic reversal. Now, market valuations can be measured in a variety of ways, but another popular metric is called the Buffett indicator. Now, I've discussed the Buffett indicator in detail in previous videos, which I'll leave a link to in the description below if you want a more detailed explanation. But in layman's terms, effectively what the Buffett indicator is it's a ratio of the total market capitalization, or the value at that time, of all stocks in the United States, divided by the US gross domestic product, or the value of all the goods produced in a single year. Historically speaking, when that ratio falls between 75 and 90%, some cases also having 75 to 100%, the market is roughly fairly valued. Ratios below that indicate that the market as a whole is significantly undervalued and may offer the possibility of greater long-term returns in the future. Conversely, when that ratio is above 90 or 100%, it may be an indication of overvaluation in the market, and hence investors should likely expect lower annual returns over the next 8 to 10 years compared to historical market averages. As of today, that ratio stands at roughly 140%, which is representative of a significantly overvalued market. By this metric to my right, that ratio is actually very close to what we saw during the dot-com bubble of the 2000s. This can be concerning for investors because we know that those that invested in 2000 saw poor returns over the next 10 years. Given these high levels of valuation, does that mean investors should just not invest in the stock market right now? Well, not necessarily, and we'll discuss that more at the end of the video, but investors should understand that elevated levels of valuation, like we're seeing now, have been correlated in the past to lower than average rates of return over the next 10 years. If I had to rate this as a risk from 1 to 5, where 1 is a risk that should be negligible to investors' returns, and 5 is a risk that has a high probability and or impact on investors' returns, I would likely rate this as a 4 or a 5. While it's possible in the short term that we still see elevated levels of valuation, in the long term, it's going to be hard to sustain these levels. While I don't know exactly when, it will eventually put downward pressure on stock prices simply due to reverting to lower, more historical levels of valuation. That's one of the biggest risks I see today in the stock market. The second biggest risk I see in the stock market right now is the level of debt. Now, debt on its own isn't necessarily bad as long as it's used effectively to produce returns beyond the cost of interest. However, individuals, corporations, and governments as well need to be careful to make sure that debt doesn't get out of hand. Federal debt owed by the US government has more than doubled since the financial crisis. If this trend continues, it can become problematic as it'll either require significant raises in taxes or dramatic cuts in government spending to keep this debt manageable. Overall, household debt has increased since the financial crisis as well. Now, despite this increasing amount of debt, household debt service payments as a percentage of disposable income, or effectively what percent of money households and families are spending on paying down debt, has actually declined dramatically since the financial crisis and has remained relatively stable since 2012. While this might seem like a good thing at first, as households appear to have more money to spend on goods or services or to invest it, this could be a bit of a sign for trouble ahead, because the primary reason why these payments as a percentage of income are relatively flat is that despite seeing an increasing amount of debt, interest rates have fallen enough to keep this percentage relatively stable. However, when interest rates begin to rise more, you'll gradually see this percentage of income that needs to go towards debt payment increase for most households. That means there's going to be more money going towards debt repayment, which doesn't directly add to economic growth. Now, since the housing bubble, we've actually seen that US mortgage debt has been relatively flat and is actually below the financial crisis peak over the last 10 years. Part of the reason why we're seeing such an increase in the personal debt of households is the dramatic increase in federal student loan debt that has been issued since the financial crisis. As you can see from this graph, federal loan issuance exploded following the financial crisis and currently is showing no signs of abating. This means compared to past generations that graduated college or high school and entered the labor force with a relatively clean slate, many of today's graduates are burdened with significant student loans that may saddle them for several years. However, the group whose debt growth worries me the most is actually that of corporations. Corporate debt issuance has exploded dramatically since the financial crisis, and this imposes a significant risk for stock market investors. Investors in stocks or equities only get returns after bondholders are paid. When companies hit hard times, stock prices can dramatically fall because bondholders are the first to get paid. Remember, if a bondholder is not paid, the company is going under. Greater amounts of debt within a corporation means that they have less flexibility in determining how they can use future cash flow. If more and more of that cash flow needs to be used to cover interest on their debt, that company may run into trouble should they see an earnings decline. Going back to our graph of the S&P 500, this is why recessions can be very dramatic for stock market returns. When there's a decline in earnings and high levels of debt, some companies may end up going bankrupt as they're unable to make those debt servicing payments to their bondholders. This was the case for several companies during both recessions, which is why it can greatly dampen stock market returns. Knowing this, keep in mind the debt levels of the companies you're investing in, and consider how each of them might perform during a recession or during a period of poor financial performance. If I had to rate this risk on a scale of 1 to 5, I would probably put this around a 4. Obviously, each company is different and has their own balance sheet, so some companies might be better positioned than others. Going forward, I would make sure to consider the debt levels of each investment you're taking, as that can become quickly relevant if we see any recessionary period. And one of the other 3 biggest risks I see in the market right now is interest rates. Specifically, the impact that rising interest rates will have on both the economy and the stock market. So behind me is a graph of the 10-year Treasury yield. Currently, that rate is roughly about 3%. However, if you look over the past 55 years, that is still very low compared to historical averages. Along with other factors, that increasing debt that we saw in the second risk is likely going to cause interest rates to rise in the future. Those rising interest rates will have a significant impact on all aspects of the economy. For one, that ballooning corporate debt will need to be refinanced at a higher interest rate, which means more interest payments and therefore less earnings. Additionally, mortgage rates, which are very closely tied to the long-term interest rate, will begin to rise as well. Given that the average sale price of a home in the United States is now nearly $400,000, that's going to mean that housing is going to become less affordable, impacting demand for housing and the housing market. Now, a mortgage of $400,000 at an interest rate of 4% over 30 years would cost someone about $1,900 a month to service that mortgage. Now that 4% interest rate is what we saw back in 2015, but since then, interest rates have now increased to roughly around 5%. At an interest rate of 5%, that same $400,000 loan will now cost an additional almost $250 per month to service. At 6%, you're now looking at roughly $2,400 a month, and going to 7% adds an additional roughly $260 per month in interest. Now, a 7% mortgage rate might seem ridiculous compared to the rates we've seen during this low interest rate environment. However, keep in mind that less than 12 years ago, average mortgage rates were actually 6.6%. A reversion to rates we've seen just 12 years ago wouldn't be completely unprecedented. Additionally, if you look at the amount of interest that the federal government needs to pay each year to service its debts, that's going to start increasing very quickly if we start to see a more significant rise in interest rates. Despite the significant increase in federal debt since 2000, interest payments by the federal government have been relatively flat over this period of time, and that's primarily due to decreasing interest rates. However, if you have the federal government continuing to spend and issue more debt, and interest rates begin to rise, then you're going to start to see federal interest payments start to rise exponentially. While we're early into this trend, this is a bit what you're seeing over these last 3 years with this sudden spike up in interest payments due. If I had to rate this risk from 1 to 5, I would likely rate it a 3 or 4. The reason being is that it really should be a 3, but given the increased amount of debt by individuals, corporations, and governments, this makes them all much more sensitive to rises in the interest rate. Now, overall, given these significant risks, does that mean you should stop investing entirely? And the answer to that is no, and I'm going to explain now some of my perspective as to how I'm navigating these risks and some advice that might help you navigate periods of stock market volatility. The first is to keep a long-term perspective. The reality is, in the short term, no one knows exactly which direction the market is going. However, in the long term, if you buy companies at a fair value below what you reasonably think they're worth, you'll be just fine in the long term. Over the long term, stock market returns will follow a company's earnings. However, as we saw with the first risk, sometimes those valuations of the stock price can become detached from those business fundamentals. My second piece of advice, and something I try to practice as much as possible, is to tune out the day-to-day noise. This is the news section of finviz.com, and it's filled with financial articles and opinions. Now, this isn't even from a single day, and you'll be inundated with information unless you can take control of it. I would probably wager that at least 95% of this day-to-day news that you see on the stock market is simply noise that isn't going to add any value to your decision-making process. Now, of course, this isn't to say stop researching entirely, but make sure you distinguish between actual genuine research and news headlines. Find sources that you can trust, focus on those, and tune out the rest. My third piece of advice is to level set your expectations for investing. What I mean by this is that you should have reasonable, long-term expectations for what you should expect to return through investing. Over the long term, the stock market has returned roughly 7 to 10% per year. However, that can vary depending on which periods you're investing in. Historically speaking, returns from overvalued periods in time typically produce returns that are below the historical average. For instance, based off the Buffett indicator, this model is expecting a negative 1.6 return over the next years for the S&P 500, including dividends. And that's based on this level of overvaluation and our current interest rate. Now, it's certainly possible that valuations can remain elevated, but I think this should be a sign to investors that future returns from this point on forward are likely not going to be the 8 to 10% that we've seen in the past. With that being said, is there any hope for investors? And to answer that, I'll lead into my fourth and final piece of advice for today, which is that there are still opportunities within the market. Now, this is a heat map of the S&P 500 components and their 3-month performance, which effectively covers this most recent period of stock market volatility. Notice that while the markets were down over this period, there were some individual stocks that actually performed quite well during the same period of time. It's a widely noted phenomenon that individual and active investors typically outperform passive index funds during bear or down markets. This means that if you're an enterprising investor willing to do a little research, you may be able to find some opportunities with individual stocks that right now might provide better returns with less risk than the general stock market. That's effectively what I'm doing right now, trying to find and identify companies that I believe are trading below their intrinsic value. While in the short term, those stocks could certainly experience volatility, in the long term, I expect them to have less downside risks than the market at this point. Overall, I hope you got some good value out of that video and provide some perspective on what I think are some of the biggest market risks right now. Also, I want to say thank you to our over 10,000 subscribers. That's an exciting milestone, and I can't thank you enough for your support. I'm working on a special video on that for the future, but until then, thank you so much for watching. My name's Michael, and I will see you in the next video.